folks. Welcome to the Saving with Steve show, where we talk about the ins and outs of money, pretty much everything in the sun relates to you having a happier, healthier relationship with money. My name is Steve Sexton. I want to thank you for joining us today. We've got a wonderful segment here today. This week's all about how to build your credit and why credit is critical. Good credit is critical. Today we have Cynthia Chen. She's the co-founder and CEO of Kikoff, a financial technology company dedicated to helping individuals achieve financial health through credit building. Now, Kickoff was built on the belief that predatory financial services shouldn't exist. And I think that's important as well. As a consumer-focused personal finance platform, Kickoff is making financial progress accessible, especially for those overlooked by traditional systems. A little bit about our guest today, Cynthia Chen. Besides being the co-founder and CEO of Kickoff, she has extensive experience and commitment to financial inclusions, having positions herself as a notable figure in the fintech industry, drives initiatives that democratize financial health for the broader audience. Hey, I'd like to welcome Cynthia Chen to the show. Cynthia, thanks for being here today.
Thank you for having me, Steve.
Now, one of the big things about having or working towards an area where, especially in the financial lending business and credit, where, you know what, it shouldn't be predatory. I think that's a big thing, and a lot of our listeners are looking forward to what you have to say today. So I want to thank you for that. But I'd like everybody to understand, hey, what got you into this business? My understanding, and I'm going to let you take it from here, you moved over to the United States at 17 from China. Is that right?
Yes, I did. I immigrated to the United States at the age of 17, all by myself,
Oh,
with
wow.
no family, no friends, no money, and obviously no credit. So I had my own very interesting journey of finding my way in this country and also navigating this country's very unique credit system. When I first arrived in the United States, I was a college student, a freshman at Columbia, and I noticed that many of my classmates had personal credit cards with which they used to purchase textbooks and other items like a laptop. And I did not have that. I got really intrigued by this idea and started to do some homework. The more I learned about it, the more I realized that it was very important as a new immigrant to build credit in the US because later in life, you need to get your first car, lease your first apartment, and even pass the employment background check, which included a credit check for your first job. So I decided to start early. On my 18th birthday, I did not spend the night celebrating entering adulthood. And instead, I went to the computer lab in my dorm building and completed an online application for a credit card, a student credit card for Columbia, and got approved with a $500 credit limit. And then over the course of 2 years, I responsibly paid off my monthly balance in full and accumulated a lot of good payment history, and then achieved a credit score well north of 700, which helped me a lot upon graduation in terms of getting my car, signing my own lease at age 20 or 21, and also passing Capital One's employment background check. Later in life, I realized that there were many Americans just like myself who did not have anyone to rely on when they came to credit building. So that's why I started Kickoff in November 2019 to help millions of Americans build credit.
Oh, wow. That's great. You know what? For a person who way back in the day, I remember it was just like, okay, got to get a credit card. That's what you do. And most people don't realize that it's an obligation. So they don't realize it's an obligation. And like with yourself, you were able to build a significant credit score just right out of college with one simple student credit card. And I think that's great. So here's some of the big questions. You talked about there's many reasons why having a good, solid credit report is important. You talked about getting a job, leasing an apartment. What are the other things that enable somebody to prosper in life because they have a good, solid credit score?
Other things would include being able to get a mortgage and become a homeowner. Home ownership is still a very important pillar of the American dream. And in order to get an affordable mortgage, you usually will need a decent credit score. If you
Mhm.
don't, then you may end up renting for your entire life, and that will cost you a lot of rent. And you would miss the opportunity to accumulate home equity, which can be a really valuable asset when it comes to your kids' college education or your own retirement. And there are also other things that you will need a good credit score for. For example, if you are a small business owner and you are going to apply for a certain license, sometimes the regulator who approve those licenses will need you to pass a background check. And that will include credit report and credit score check because they want to make sure that whoever operate in that regulated field is financially responsible.
Oh, I actually agree with that because I know not only in the lending field, like with mortgages, financial planning, all those type of things, nobody wants somebody that doesn't have good credit to provide financial advice or to have an incentive to have the wrong incentive if they're having payment issues and things like that. So I think that's
Exactly.
actually,
Yeah. And very few people will really want to date or even marry someone who has a lot of debt problems and extremely low credit scores. We've actually got feedback from our own users who say that they would like their other half to have decent credit scores.
in fact, it was very interesting. We had over 300 people who emailed in to our viewers line at viewers@savingwithsteve.us, and it indicated that before they got married, they actually said, "Pull out your credit score. Tell me your debt. I want to know what I'm getting into." And some of them says, "You know what? They didn't move forward with the marriage because of the other person's spending and credit habits." So that's like a deal breaker for some people. But the other part, some of them actually says they knew their spouse had some or future spouse had issues, but they came up with a plan to put things in a better position before they actually got married and all that. So I think that's very key because a lot of people don't think about that. A lot of people think, "Hey, I'll just get married."
Yeah, that's a very prudent, responsible thing to do because love can be blind, but financial compatibility needs to be checked
Mhm.
before making a big lifetime commitment and solving all the problems, making sure that you have a really good plan that will support a long-lasting marriage is very important.
Well, actually, the number one reason for divorce is financial stress. So, you know what? If you're starting out on the wrong foot, it's not a good idea. So, I totally agree with that. Hey, folks, you want to stick with us? We're going to be right back with more Saving with Steve and Cynthia Chen here with Kickoff. Welcome back to the Saving with Steve show, where we talk about the ins and outs of money. Again, I want to thank you for joining us and sharing us with your friends and family. Folks, all the replays are available at savingwithsteve.us. If you're enjoying the stories of helpful information and insight on Saving with Steve, I encourage you to subscribe to our YouTube channel. Never miss a show. Check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York City, E360 TV, Las Vegas TV networks. All these networks are dedicated to empowering you to solve problems, uplift the spirit, and live a life of personal and financial freedom. So again, hey, you can follow us on Facebook at Saving with Steve Sexton on the Insiders Club. You can get guest gifts, see the replays, the whole shot. But right now, we want to get back to Cynthia Chen, and we want to talk about, hey, Cynthia, what are the strategies or key strategies for people looking to build credit?
The key strategy is to make sure that you have positive payment records reported to the credit bureaus because positive payment history is the biggest factor in the credit score calculation above anything else. So first and foremost, do not miss any payment. Try to sign up for auto pay so that you're on autopilot and you're a lot less likely to miss a payment. And if you do not have many items that are currently on your credit report, think about using credit builder programs such as Kikoff's products to report more positive items to the credit bureaus so that they can enrich your credit profile and also help your credit score.
So how does that work?
You can have a number of different ways of building credit. For example, you can have the things that you're already paying for, such as your rent and utilities payments, sent to the credit bureaus. At Kickoff, we offer a program where we can help credit builders send rent and credit and utilities payments to the major credit bureaus. And you can also open an account for credit building, such as a Kickoff credit account, where your monthly payments will be reported to all three major credit bureaus. And other tools include a secured credit card, which we also offer in partnership with a bank sponsor. And another tool is called the credit building savings loan, which serves two purposes. One is credit building, one is saving. You can pay us $10 per month over 12 months. At the end of 12 months, you get all your $120 back with no interest, no fees, and we'll report all your 12 payments to the credit bureaus so that you get a lot of positive payment history.
Okay. Is there another thing that people can do with your program?
Other things include really monitoring your utilization rate very carefully. That's the second most important thing in the credit score calculation next to positive payment history. We provide real-time utilization rate monitoring so that you can be very careful to not accumulate a lot of balances on your revolving credit cards and credit lines with impulsive purchases, especially during the holiday season. Because if your utilization rate increases to about 30%, it can have a very significant negative impact on your credit score. I once had a credit card that had a temporary increase in utilization rate, and my credit score dropped from 800 to mid 600. It is very significant, more significant than most people are aware of.
Wow, I didn't realize it. So I have a couple, I want to say client questions, but basically they're viewer questions. And a secure credit card. What's a secure credit card?
A secured credit card is a credit card that is secured or collateralized by a security deposit, and your ability to spend is tied to the amount of security deposit you have. So there is really no chance for you to charge off on a secured credit card because even if you cannot pay back your balance, your security deposit will be used to pay off that balance. So it's a lower risk way of building credit as your spending power is limited by the money you already have. So you are less likely to get into debt problems with that.
And you know what? For years, I was told a long time ago, hey, make sure your rent payments or go onto your credit report. And I never knew how to do that. And I don't think many people know how to do that, but you have a program that enables somebody to get their utility payments, their rent payments listed on their credit report to show they're making consistent payments.
Yes, we do. We do that by asking our users to upload their lease agreement so that we can verify that the lease does exist. And then they can integrate their bank transaction data with us. And we
Mhm.
will automatically screen for their monthly rent payments. And once verified, report them to the credit bureaus. And the same goes for utilities payments. Although for utilities, we do not even need any lease verification. We just look at your bank statements, spot those payments, and get them reported.
I think that's wonderful because in the past, basically all people had to do was spend on their credit cards and make sure they make great payments, but they're still getting hit with interest rates. So just by doing that, they don't have to pay any additional interest or have additional fees. They're just getting it reported. I think that's wonderful. That really is something big, especially if you're getting started. Now, one of the questions that I have, and you answered part of it here, is using that system, you know what, you can build credit without paying fees, the extra interest? Is there other ways that people can build credit without paying the fees and the interest?
Other ways that people can build credit without the fees and interest will include, for example, our credit builder savings loan, which is a savings account. You put money into FDIC insured bank account that was established for your benefit. You make monthly payments, and then monthly payments get reported to the credit bureaus. And Kickoff does not charge any interest on that
That's
product. It's
cool.
a zero APR product, and you get your $420 back at the end of the loan term.
The cool thing about that is people don't have to have a lot of money in there. It could be smaller amounts of money that can make it work, which is great.
$10 per month is like 2 cups of coffee.
Yeah. Depending on where you're going, it could be one.
That is true. The Starbucks holiday special, yes, can be $10.
Okay. One of the questions that our viewers have is, what if somebody already has some bad credit? What are the steps that would be best taken to increase that credit score, stop the credit from going bad, that type of thing?
There are a number of things that people can do. Usually, when someone has bad credit, it's because the person has been in some type of financial distress and has missed some payments on some debt obligations, or even sometimes a parking ticket that is overdue can destroy your credit.
Oh,
Yeah, for real, yes.
I didn't know
Oh, it
that.
can definitely destroy your credit. One of the people that I came to know told me that her credit score was extremely low because she totaled her car in an accident, which is already very unfortunate, and her car got pulled and parked at some like junkyard, and she owed that junkyard parking fees for her totaled car. She was not able to pay for that because she was a poor student, and that overdue parking fee just destroyed her credit. It was very hard for her to get an apartment. So things like that happen. The medical debt, they are still getting reported to the credit bureaus. If you have medical debt in collections above $500, it may impact your credit very negatively. We have lots of Americans who have this problem. But the good news is that there are certain proven ways to help you deal with them. For example, many Americans actually have some inaccuracies or errors in their credit reports that are dragging them down. So you can look at your 3 credit reports, cross compare them, and see whether there's any inconsistency across those 3 credit bureaus reports. If there is, then one of the bureaus data must be wrong. And then you can dispute that inaccurately reported data with the credit bureau. And then the data reporter is obligated to conduct research and then get back to you and fix any mistakes that were made. If it do not respond in time, then the credit bureau will be required by law to delete that negative trade line. So that is a very important tool that people can use. And at Kickoff, we do offer that tool to our members. As long as we have access to their credit reports, we can help them automatically identify areas that may be inaccurate and allow them a way to directly report that to credit bureaus. That's one. You can try to
Cynthia,
identify
I
and
need to take a quick break. Folks, sorry, Cynthia, we're just hitting the break line here. So, hey, folks, you really want to listen to this because it'll make a difference in your life. So stick with us. We're going to be right back with some Saving with Steve and Cynthia Chen at Kickoff. Hey, welcome back to the Saving with Steve show where we talk about the ins and outs of money. We're hearing so many little ahas when it comes to building your credit or rebuilding your credit with Cynthia Chen here at Kickoffs. So we're going to get right back to it. Cynthia, you were talking about how people can remove inaccuracies from their credit reports. And a lot of people don't realize, and I want to just say this, a lot of people don't realize, hey, medical debt, parking tickets that could affect your traffic, your credit report. If you have that situation, know you're not alone. So it's important to understand that, number one. And number two, what if something's wrong on your credit report? you could do something about it. And Cynthia just went through that just before. So, what would be the next step for people to, how can they rebuild their credit?
Besides addressing the inaccurately reported negative items, you can also do something to the items that you're struggling with, but were accurately reported. You couldn't dispute them because they were accurate, but it doesn't mean that you're helpless. One thing that very few consumers are aware of is that very often, more often than not, creditors and debt collectors are very willing to accept partial payments or enter a debt relief or a debt settlement plan with the consumers. For example, if you owe a bank $5,000 on your credit card, you're really struggling to pay for that because you recently got divorced or you lost your job or you got sick and your income got impacted, you could definitely negotiate with Capital One and ask to enter a debt settlement plan, which would immediately reduce the amount of debt you owe by as much as 50%, and then allow you to pay them off either in a smaller lump sum payment or in fixed monthly installment payments over a period of 2 to 5 years, so that you will no longer be harassed by debt collectors' calls. You no longer will need to worry about getting sued by your creditor. And you don't even need to think about potentially filing for bankruptcy. And we actually offer a tool to help consumers deal with that otherwise intimidating and stressful debt relief conversation with their lenders with AI voice agent. If we have access to all your credit reports, we'll be able to see the debts that you're struggling to pay. And if you give us permission, then we will create a digital agent with a voice that you prefer and have that agent directly call your lenders and ask on your behalf for debt relief. And we have done that for many Americans and achieved millions of reduction in debt under debt settlement plans for them.
That's wonderful. I never know. I know AI was really big, but I didn't know you could create an agent to make a phone call on your behalf. And that the really cool thing about that is that AI agents probably unemotional like you are when you're dealing with this stuff, and they're not susceptible to the pressure. They just keep working it for you, which is great.
Yes, we've got feedback from consumers, especially those with a disability who cannot speak or hear, and they feel this is a really game changer for them. Because most often these things are negotiated over the phone, and if you are unable to talk or unable to hear, it is impossible for you to get relief.
Yeah, that's something else. Wow. I didn't, I knew people are using AI and they're using the interaction stuff, but I didn't know you could do it with credit. And I think that's wonderful. Now, one of the big questions that I have has to do with the scams, the gimmicks that people need to stay away from when it comes to building their credit.
People should really be alert because there are definitely predatory players who are trying to take advantage of consumers' eagerness in building or rebuilding their credit. I personally even received such advertisement from some companies that are not even reporting anything to the credit bureaus, but advertise a credit building product. So it is very important before you sign up for a product to make sure that the company does have an official authorized relationship with the three major credit bureaus, Equifax, Experian, and TransUnion, so that they can report data and their data will be entering your credit reports. I would verify that
So
with
how do they,
this
I'm
provider.
sorry, how do the people do that? Because that's one of the big questions. How do you validate a firm has an official relationship with the three credit bureaus?
There are a couple of ways. If a firm has a official relationship with the three credit bureaus, very often the firm will display the three credit bureaus logos on their website because they are an authorized official partner and they can follow the credit bureau's rules in displaying the logos to prove their relationship. So that's number one. And number two is look at the reviews. If there are consumers who are posting reviews in the App Store that talk about credit reporting and credit score impact, then that is real. But if there's no such review that endorses this product service, then it's probably unreal.
Okay, I get that. So, what other ways that people can stay away from the scams and the gimmicks and things like that?
If it is extremely expensive and I don't have something that doesn't sound to be true, then you should stay away from that. For example, if someone wants to charge you $200 a month or even over $100 a month for building credit, that is probably scam because it shouldn't cost that much. And
Okay,
also, if they are promising you, say, a $30,000 credit limit, that is not going to be true because $30,000 credit limit is extremely high. Very few companies can offer that as a credit building product. They probably would never offer such a product if they're a legitimate company.
yeah. No, I understand that. I was surprised how they do it. That's probably the little bait. Is there any other gimmicks that people need to be aware of?
Other gimmicks will include things like we will guarantee, say, a 100-point or 200-point score increase
Oh, okay. I've
in a
seen
certain
those.
time frame. Yeah, because the credit score is a very sophisticated model. There are not that many things that a single company can do to impact a credit score so precisely in a very short time frame because lots of other things may happen to a consumer's credit score. The consumer may miss a payment on another account that's not related to credit building. They may make a new purchase, which temporarily increases their utilization, and their credit score may take a 100-point hit.
Mhm.
So even if you use credit building products, the truth is, if there are other moving pieces in your credit reports impact your credit scores, you may not get the immediate benefit that is advertised. So if anyone is just advertising very boldly and say 100-point increase guaranteed in 30 days, it's probably not true.
Okay. So we've got a couple minutes left. I'd just like you to take a moment and tell us about Kickoff, what they do for people, how they get in touch with you, and stuff like that.
Kickoff is a consumer finance platform with a mission to empower everyone to achieve financial security regardless of their background. We help people build credit, reduce debt via this AI voice agent debt negotiation, and also save money. We have services such as bill negotiation. So if you're unhappy with the bills you're paying Comcast or Verizon, we can help you contact those companies and potentially get you into a lower price plan. So we are really trying to help consumers with everything that they need to pay for, including their debt and including their bills. And we also want to help them with access to more affordable and larger credit with our credit building services so that when they do need to, they have access to really good credit. And we hope that we can turn millions of Americans from credit building to home buying and realize their American dream.
That's wonderful. So do people just go to kickoff.com? How do they get in touch with everybody?
People can come to kickoff.com. It's Kikoff without the C. And they can also download our apps in the App Store and Google Play Store. Just search Kikoff in the App Store and pop up.
Cynthia, I just want to say thank you so very much. I think you have a wonderful journey, and I know it's going to continue. And I appreciate and I know everybody appreciates what you're doing to help people raise credit or build credit. I think every college student should be following your footsteps and just getting connected with you because having a large credit score, especially out of college, will make a gigantic difference. So, again, thanks for being with us today. I hope you have a wonderful Thanksgiving and Christmas and the whole shot. So, folks, you want to stick with us? We'll be right back with more Saving with Steve. Hey, welcome back to the Saving with Steve show where we talk about the ins and outs of money. Truly want to thank you and appreciate you for sharing with your friends, family, and associates and with the show. All the replays are available at savingwithsteve.us. If you enjoyed the stories of helpful insight and information on Saving with Steve, you know what? I encourage you to subscribe to our YouTube channel, so you never miss a show. Check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York City, E360 TV, Las Vegas TV networks. All these networks are dedicated to empowering you to solve problems, uplift your spirit, and live a life of personal and financial freedom. Also, follow us at Facebook. You can join the Saving with Steve's Insider Club at savingwithsteve.us. Get all our replays, exclusive access to our show videos, guest gifts. Hey, take your life to the next level. Now, one of the things I want to talk about is the last couple of weeks that we're seeing here in the market. One of the interesting things that occurred in November, and it was really a wild week the last couple of weeks in November. And the reason why I say it's the last week is we had NVIDIA report their earnings and they blew everything out of the water. The market went up about 1.25%, and then it proceeded to drop by 1.5%. A reversal. Why? Because basically what they were saying is, hey, AI is okay and there's still room to grow. And then the reversal hit. And it just is mystifying, as a matter of fact. But the bottom line seeing is this. See, the market at that time reflects all the positives from the AI frenzy and then some. But the investors, people like you, just can't shake that thing in the back of their head, that feeling that all of this with AI has gone a little too far. Now, the interesting thing about the market is we heard one of the Fed chairmen or Federal Review Boards talk about, hey, we're positioned to raise interest rates. When the previous meeting, they were all at odds with each other on whether to raise or lower interest rates. Okay. So we obviously saw the market move forward. Okay. Now, when you think about that shaky feeling that you have in the back of your head that things have gone a little bit too far, you know what? The reality is something's going to crack. It's either going to be in the tech, broader economy. You could pick your worry. Companies are borrowing $400 billion to build these gigantic data centers. Private lending, that we heard a little couple months ago, is hiding more blowups with their lending. The economy and the consumers are faltering. We're already hearing about that. The Federal Reserve could or could not raise rates anytime soon. So, folks, now is the time we want to, and you know what, you want to talk about this. Your performance money, the money that you designed just to be for growth and you don't have any obligation to, is situated to take advantages of some of this exuberance, but at the same time have a mechanism in place to react when this exuberance comes to an end. And we'll be talking about in a little bit. Folks, this is a great time. And you know what? We get asked this question all the time with our viewers. You know what? They say, hey, what should if I manage my own portfolio, what should I be asking myself? What should I be asking that advisor today that I've entrusted to maintain my lifestyle, maintain my legacy? Okay. What should I be asking right now? What should I be doing? What are the questions I should be doing? Okay. So here's the thing. You need to answer these questions for yourself if you're self-managing, or if the person you hired to ensure your lifestyle stays intact and so does your legacy, you want to make sure you get some solid answers. So the first question is, how is your portfolio engineered, your current portfolio engineered to take advantage of, take the opportunities of the good time? How is it engineered to take advantage of this exuberance that's going on right now? And keep in mind, if you think about what people like Berkshire Hathaways and Warren Buffett do, okay, to remember that in chaos, there are always opportunities. And if you heard me earlier, you heard me talk about how people in the back of their heads are thinking, hey, maybe it's gone too far or it's about to go too far. And you know what? Many people have that feeling that we've got this balloon. Remember that big movie, The Red Balloon, where the balloon just floats around and then finally hits a pin and explodes? It's like, you know what? Somebody's blowing, got all that gum and they blew the big bubble and you just know it's going to happen, know it's going to happen. And somebody finally picks it with their fin and it pops. Okay. So here we are. We got that red balloon floating around Wall Street looking for a pin. We all know when the pin hits the balloon, what's gonna happen? It's gonna pop. So the next question is, you need to be asking yourself or your advisor, how is your portfolio engineered to absorb the losses? Question number three is dealing with uncertainty. We've seen what's happened over the last year. Uncertainty over the next foreseeable future is going to be ruling a lot of decisions now. We are in an uncertain world, whether it be the wars, the economy, what's going on with AI. But how is your portfolio engineered to navigate through uncertainty to ensure you come through unscathed with your lifestyle intact? And this is important, folks, because you know what? We hear from thousands of people about what they'd like to hear about on the show. One of the big questions is this, and one of the things we're realizing with a lot of people who listen to the show is, you know what? If they're retired or they're just about to retire, they've done a good job preparing themselves for retirement. So it's not like they're going to be running out of money. Their biggest concerns is financial disruption because it could affect their lifestyle, their legacy. And the statement you want to think about is, you know what? You didn't build it to lose it. You built it to spend it. You built it to give it to somebody that you love and care about as part of your legacy. So it's important to start looking at how, what do we set these things up? How do we prepare for money that we call purpose money? Money that's designed to support the continuation of the lifestyle for your spouse, to cover the daily living, the long-term care. Okay. And then we have performance money. Okay. The first portion, that purpose money, is obligated to you to cover your daily living, your travel, your long-term care, the continuation of your spouse. And then you have performance money. It's unobligated. You know what? This doesn't affect your lifestyle because you've already got it covered. It's that money, whether it goes up or down, you're fine. You just want to make sure it has a growth pattern moving forward in the future for the long term. You use it, might be for giving extra money to your heirs or buying big purchases. So that's performance money. It's not unobligated, has no other obligation other than to grow. So the thing here, folks, is if you're getting close to or about to be in retirement, you want to think about those two things. Making sure you have a portion of money that's to sustain, support your lifestyle. Because if you think about it and you go back through the history of the market or even the last 25 years, I'm going to bet if you're listening to me now, you're probably working in your mid 20s all the way up to your mid 60s. You might have been working for 35, 40 years to amass what you have amassed today, the assets that you have. And if you write down those assets, and you go back to a 10-year period like 2000, where we had 2001, 2, 3, were all negative, and then you had 2008, and you go down to 2020, if you're taking out income to support and maintain your lifestyle, as well as you having the money in the market at that time, you have half of what you had when you started. So look at your portfolio. Make sure you understand what your definition of risk is. And I understand a lot of people have different definitions of risk, but at the end of the day, that volatility eats up your principal. And if it's going to eat up your principal, how much can you afford to lose? And don't say a percentage. I can lose 10%. If you have $3 million, are you comfortable losing 300,000? Maybe it's 15%. Maybe it's $450,000. Maybe it's 20%. That's $600,000 of your portfolio that you might not be getting back, or the amount of money that you take out has to be reduced so you can get it back to where you was before, which means you're going to adjust your lifestyle. So what is your definition of risk from that perspective? And then start looking at, hey, how do I create the position of the assets for the performance assets, as well as the ones that are going to support my lifestyle from the purpose assets. Folks, I do want to thank you for joining us today. You can always go to savingwithsteve.us. Helpful insights on information on Saving with Steve. I encourage you to subscribe to our YouTube channel so you never miss a show. Check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio, New York City. All these networks are dedicated to empowering you to solve problems, to uplift your spirit, and live a life of personal and financial freedom. With that, folks, I do want to thank you all for joining us today. Cynthia Chen was just wonderful. If you're from the age of 21 all the way up to 65, whether you have no credit, new credit, or just want to build your credit, they offer an opportunity that would enable you to build credit, establish credit with little or no cost in the way of fees and interest, just with the programs. And if you do have some issues with credit, they have the tools to help you. Could you imagine having an AI expert or an AI personality negotiate for yourself? They don't have any of your emotion. They don't have any of your guilt, your concerns, or anything like that. That's wonderful. So you want to go to kickoff.com and check that out. With that, again, I want to thank you for joining us today. Stick with us. We'll look forward to seeing you next week right here on Saving with Steve.